Assalamu alaikum. This is lecture 34 of Advanced Cost and Management Accounting. We have been discussing the performance measurement of organization by the use of the balance scorecard. The balance scorecard we have discussed is looking at the organization from a number of perspectives. It is looking at the various perspectives that cover different parts, and it is measuring, and it has become a management system to ensure that strategy of the organization is translated into objectives, specific objectives, and it is set and documented how each particular performance objective is going to be measured and what is the target to be achieved. So this is what the balance scorecard overall provides us. And we looked at the various examples, and we looked at the benefits and limitations of this. We can call almost the management system and management by use of balance scorecard. Now we are going to go ahead and look at the various perspectives. We covered 4 perspectives. We covered the financial perspective, the customer perspective, internal process perspective, and the learning and growth perspective. In all of these 4 perspectives, we are now going to go ahead and see what can be possible objectives and what can be their measurement criteria in more detail. So when we look at the financial perspective, we have said that businesses have normally measured their performance more or less in the lines of the financial perspective. In other words, they set profit criteria, they set budgeted costs, annual budgeted costs, which are incorporated in an annual operating plan. So the plan sets out the various sales activities, the volumes, the prices, the revenue, as well as the different cost categories and what costs are going to be incurred, and therefore a planned profit. This has been how traditionally businesses have been looked at, and their planned profit and cost and revenues, etc., are being monitored at different intervals during the period, and wherever there is departure or significant departure, then the causes are looked at and identified, and some kind of corrective action taken by the organization to come in line with the plan and the budgets. This has been basically performance measurement of organizations traditionally. Now organizations are beginning to find that in order to achieve this financial perspective, it needs to have greater emphasis and target setting and objective setting and performance measurement of various different perspectives within the organization. And it has to identify the operations, the means and targets for excelling in what they are doing, and for ensuring that they produce qualities and products which are A, demanded by the customers, and B, of the quality and also of the price that is acceptable in a globally competitive environment. So businesses have become tougher, boundaries have stretched, trade has become easier, people can source their materials, their components, their parts, their goods, their products from very different parts of the world, and therefore this has created a need for excelling and for minimizing cost and for having businesses that are producing the right type of goods and producing them in the right kind of period and at a good price. The cost has to be minimized, managed so that the price can be competitive. So in this environment, just focusing on the budget was insufficient, and people are now focusing more on A, the operations that they are conducting, the processes which they are involved in, B, a very large focus has turned towards the customer, in identifying the needs of the customer, in identifying how to satisfy the customer, how to build in quality which is required by the customer. And don't forget, the customer is also getting more and more choosy and more picky and more selective about what it is going to consume and acquire and buy. So customer perspective has gained an enormous attention and focus, and a great deal of time and effort is being spent by organizations in identifying customer requirements, monitoring quality, and presenting the customers with goods at prices that are affordable. So in this environment where the customer has become very important, the operating efficiency has become very important, and the growth and continuity of the organization has become very important. Stagnation is the same as decline, virtually, because stagnation doesn't continue. There is no sustaining at a stagnant level. So growth has become equally important, and therefore learning and growth and training, etc., has gained a different priority and a different perspective. So the balanced scorecard is giving you an indication of how to build in various objectives and various strategies, and how to communicate them into your organization, and how to measure them, and how to later on bring in initiatives, etc., to monitor and measure and set targets. This is designed for the accomplishment of overall organization objectives. We are going to look at the different perspectives of the balanced scorecard, and we are going to look at the potential objectives that can be set and how they can be measured. Let's look at the financial perspective first. Establishing objectives and performance measures. The financial perspective. Objectives: operating profit, return on investment, net profit, economic value added. In addition, revenue growth, cost reduction, and asset utilization. So from the financial perspective, which we are saying is not a new perspective from the balanced scorecard point of view, as it has existed, and finance has always been important and measured, and it has always been monitored by organizations traditionally. What are the kind of objectives that you set in the financial perspective? You can set a rate of return on investment. Return on investment is measured by profitability on the one hand, and the investment made by the sponsors, the owners, on the other hand. The exact mechanism and computation and formula, etc., of these financial objectives is covered in other financial courses like financial management and financial accounting, etc. So we are going to refer to these financial measures and not go into the detail of their calculation and computation. We just need to understand what these objectives are and what they represent. One objective, of course, is the operating profit. The operating profit is the profit from operations. In other words, the revenue from your sales less the cost of selling, the cost of goods sold. The cost of goods sold present you with an operating profit, and what is not included perhaps in operating profit is the marketing expense, the admin expense, and the finance cost. So these are the kind of costs that are not included in the operating profit. Operating profit is dealing mainly with the sale and cost of goods sold. So the operations, what have they resulted in? That is giving you one measure and one objective of finance which is used very commonly. What is operating profit? So operating profit represents a measure of the organization's performance. The other one we said another one is return on investment. Return on investment is also looking at profitability, but it is relating the profitability to the investment made and looking at that as a percentage. And you can set objectives on what percentage return the organization and the business should produce. So return on investment, operating profit, net profit, that's another objective. So you have operating profit and net profit. And we just said that the items which are not included in operating profit are expenses such as marketing expense, administration expense, and financial charges. So when you have deducted these expenses, you arrive at the net profit. So net profit can be looked at as an objective as well as operating profit. And in fact, when you look at both, you get an idea of how much profitable the operations are and what are the other non-operating overheads, you can say. And that will identify the costs that can be reduced and the cost efficiencies that can be built in. So net operating profit, and we said other financial objectives include revenue growth. Revenue growth can be measured in two ways, and it is in two parts. One part is the growth in volume, the volume growth, and then the other is the price growth, the increase in price. As time goes by, organizations will find it important to increase the prices to keep up with the rise in costs and the rise in inflation, etc. So the revenue can increase on two accounts. One is that there is volume growth, which should represent what is real growth, and the other is what is price growth, increase in prices. Of course, when we say that we want to set objectives, we can set objectives in total revenue terms and say what is the total revenue increase going to be, and that will be comprising of both these things, the volume as well as the price. For the objective of cost reduction, there can be again cost reduction in operating expenses and in non-operating expenses. So there will be a need to identify in operating expenses, for example, how you can reduce cost of materials. And that would mean identifying various sources, alternative sources, where they can be acquired at lesser cost, or even identifying alternative materials that can be used to have the same quality and the same product, and therefore that is going to give a better cost. So cost reduction in operating side will be involved in looking at the cost of material, also in the cost of labor. Again, two things can be looked at: how labor can be made more efficient, and if there's any room, then how it can be made more cost effective and less expensive. So more effective, more efficient means that greater output is achieved from the same number of hours, and that might require training and things of that nature to make the labor more efficient. So operating costs will involve materials and labor and other operating overheads, whereas there will be then also a need to identify the areas for reducing non-operating costs. That includes administration, marketing, and finance part. Finance cost is the cost usually of borrowings and bank charges and things like that. And of course, organizations will try to minimize that by exploring different options available to them of sourcing their finances. Administration is a matter of keeping the organization lean and efficient and effective, and therefore training will be involved, the right kind of selection of employees will be involved, wastage can be avoided, losses can be avoided, things like that. And marketing is another sometimes major expense for organizations. Marketing is an important aspect, and therefore organizations can end up having large marketing budgets and great marketing expense, and there might be room to make it more effective and to reduce the cost. So cost reduction can be an objective of the financial aspect. Similarly, asset utilization. This means that the assets that you have for producing and carrying out the processes and making the final product, can they be put to better use? Is there idle time where the asset is not being used? Is there capacity which is spare and therefore it should be used to put to some good use? Similarly, are the machines running effectively and being properly maintained, and the downtime and the repair cost can be minimized? So the cost of repair, cost of downtime where the machine is not working, idle time where it is available but there is no production, all those are aspects of asset utilization, and those aspects are brought in to try to minimize the cost and improve asset utilization. If you had machines which are being used only partly, then there might be room to reorganize the equipment and assets that you have and try to increase the utilization as maximum as possible. If the assets are being used, let's say, to a capacity of 40 to 50%, this obviously implies waste and implies resources not being utilized. Therefore, the intention and the focus would be to increase the utilization of the assets, or if they are spare and idle, to dispose them, if that is the case. So asset utilization can also form a part of the objectives of the financial perspective. Typical financial objectives are to increase return on investments by 20% and or to increase sales and operating income by 100% over the next 5 years. So with these financial, you can say, objectives, you have then the targets. And very often we are saying the targets would be that to double your sales and double your profitability over 5 years, or to have a return of investment that is increasing by 20%, things like that. These are examples, and of course it will vary from business to business and from environment to environment. What are the returns and what is the profitability? Different regions have different cost structures and different labor and other energy costs, etc. And therefore profitability is going to vary from region to region. So objectives will be set according to the conditions that prevail. You can have therefore these kind of benchmark or target set for performance in the financial area for all these things. You can say costs will be reduced, and you could put a target percentage to that, 5%, 10%, whatever is appropriate. You can say that revenue will be increased or revenue will grow. And that again, you can set targets and percentages for that. Setting targets is another different aspect which we cover usually under the budgeting lessons, and they have to be realistic, and they have to take into account all the aspects for them to be realistic, and therefore there is a motivational aspect in setting targets. You set the targets too high, which can't be achieved, and there is a demoralizing effect on the workers, and because they won't achieve the targets, therefore the impact is, and the result is that they do worse than you normally expect. So that is the perspective of setting the targets on the financial objectives. Financial measures provide feedback on whether improvements in operational performance measures are being translated into improved financial performance. Ultimately, as I say, the final proof is going to be in the financial performance. The financial proof is going to be in the profitability, and the net result is going to matter and is going to count. What happens in the net result, that is what the organizations are going to ultimately look at. So the financial perspective is very important in that aspect, that it is going to then reflect whether all the other measures that you have taken to bring in efficiency and to bring in other improvements of processes, of customer behavior, everything, all those things, whether or not they have had a financial performance effect, will be reflected in the financial objectives and the financial results. So financial results ultimately are going to reflect the achievement of objectives in all other areas. That's why that is the key aspect, and no doubt about that. It has been traditionally the focus. The focus has now changed from financial to non-financial measures, but the result and the achievement of all that non-financial objectives and strategies, it must be reflected financially in the results, and that is what is going to reflect the financial performance. The results will show whether those objectives have been achieved and they have translated into financial benefit. The next perspective we look at is the customer perspective. When we are looking at the customer perspective, we are going to look at the following objectives: market share, customer retention, customer acquisition, customer satisfaction, and customer profitability. The next perspective is the customer perspective. We saw there is great focus, great importance in the customer's perspective. We are going to set the objectives for customers in these 5 areas. One is the market share. What is the market share? You have to look at that as a total size of all the goods that are available of that particular product, and the amount of goods that is being supplied by your firm, for example. So as a percentage of the total market products, so for example, if you are selling clocks and you are selling around wall hanging clocks, then you will see what are the makes that are available in the market, and then you will see what percentage of the total market is your make or your brand, and that will represent your market share. So from the customer perspective, we are going to see what is the market share. Secondly, we are going to see customer retention. Customer retention means that the same customer, when he wants to buy the same thing again, will come and buy your brand, will come back to you and will come and use your product. So you retain the customer. He comes back again and again. This is customer retention. Another aspect is going to be new customer acquisition. That means you attract more customers. It is one thing to have the same customer coming again and again, and another aspect is for newer customers to come to your product and to consume your product. So new customer acquisition, That is going to be an objective. And then after that, customer satisfaction is going to be an objective. We'll soon discuss how we are going to measure each of these objectives. Customer satisfaction is a phrase very commonly used. Customer satisfaction implies that the customer is happy with the product that you have provided. They want to use it, and they want to continue to use it, and they want to repeat. So customers don't have complaints, customers don't have negative remarks, and that is going to come from customer satisfaction. Defects in products is going to be a part of this customer satisfaction. You will not find customers are satisfied if your products are faulty and defective. The customers will come, they take the trouble, go into the market, buy what they want, take it back home. And when they find it doesn't work, this leads to customer dissatisfaction. So this is going to be considered, and we will talk about this when we look at customer satisfaction. And finally, customer profitability. Recently, in a survey and a study, it was discovered that for a large manufacturer who had a large number of customers, a very small percentage, only, 40%, which is less than the majority. So 40% of the customers were profitable, implying thereby that 60% of the customers of that organization were not profitable. So this is another aspect when you look at customers that you must look at. What kind of services that you need to provide to the customer, what kind of prices and discounts that you need to provide to the customer. Ultimately, what is the customer costing you against what is the revenue that you are getting from that customer. Sometimes when the number of customers is very large, you can do this customer profitability analysis for different segments of customers. You have segments of customers, you can divide them into different segments and say whether this type of customer, this category of customer is being profitable or not. So these are the 5 different, you can say, things that we are going to look at, objectives that we are going to set in the customer perspective, and then we'll see how to measure these objectives and what kind of targets to set. Measuring market share. As we mentioned, the market share represents your percentage of the total goods available in the market. This slide shows that you have 4, for example, suppliers available in the market, and it shows different ranking, first, second, third, and fourth, all the 4 suppliers, showing how you can find a share of each supplier. So it represents a portion or a percentage of various suppliers. So market share is going to be an important aspect for the organization to consider, where you are placed in the market, what kind of a role you have. A role from the perspective that if you have a large market share, you might be a market leader, then it is going to affect your pricing strategy. The leaders are often in a position to set the price, and the others are what they call price takers or price followers. So knowing what is the market share of your product, and of course how to go about increasing and expanding, therefore measuring market share. How do you measure market share? Market share will be measured through market surveys and a percentage of what is your product availability compared to the entire market. Measuring market share. Proportion of sales in a particular market measured as sales revenue, sales volume, or number of customers. Now we look at how to measure market share. Basically, we are measuring the proportion, and the proportion, we said, can be measured either by the volume, number of products, the revenue, or even the number of customers. These are different ways of measuring what proportion you represent in the total market. And so we can measure market share in these 3 different ways. either the volume based, the revenue based, which is the total sales value, or number of customers. Sometimes it might be possible to regard as the number of customers as being indicative of your total market share. Very often you find that the telecommunication and the mobile industry do that here in our country, in Pakistan. They will say that we have so many users, and that will reflect as a total market share. And the number of users, which are their customers, is going to be a measure of what their overall market presence is. And then they will look at the total users in the market, how many people in this country are using mobile phones, and then they can say of that total, so many number are the users of such and such brand. So that can be an indication and a measure of market share. Estimates of total market size obtained from trade associations and industry groupings. Of course, it's sometimes difficult to know the entire size of the market. You always know what is your total revenue, your total volume, or the number of your customers. But to find out what is the total size of the market, this needs some kind of investigation, etc. And very often what can help are trade associations. So if you have one industry and there's a trade association of that industry, then they can tell you what is the total size of that market. The dairy industry will have its own association, the textile industry will have its own association, the leather industry will have its own association. They will know who the different players are and how much each player is producing, and therefore what is the total size of the market. So market information, trying to get to what is the total size of the market, if there are industry groupings and trade associations available, then they can be a good source to estimate the total size of the market. And you can then assess what is your position and what is your share within that market. Indicates whether strategy adopted in achieving expected results in the target markets. So what does the share indicate? We have said that growth is an important part of the business. And so growth of the business is going to be focused, and there's going to be some targets being set. And so market share is going to be also one target. It is going to be one objective, and the target can be the increase in market share and a certain percentage. So this is going to indicate, therefore, that all the strategies and all the efforts that you have made, have they resulted in achieving what you have set out to achieve. So market share is an indication of your achieving of objectives, achieving of strategies. And where you find that the market share is growing, then you can also relate your growth in relation to the market. So if you are growing at the same rate as the market, overall market, then your share will probably remain the same. But if you are growing faster than the market, then you are going to increase your market share. Likewise, if you are growing slower than the market is growing, then your market share is declining in the overall market. So market share perspective, this is how to measure market shares, and this is how it is going to reflect whether your strategies and objectives have been met. Customer retention. Ensuring existing customers are retained, this will maintain or increase market share. The objective relating to customers, one objective is going to be customer retention. Customer retention, we said it means that you retain your customer. In other words, the customer comes to you repeatedly every time he needs to consume that product. So you are having a repeat sales to the same customer. So customer retention, we are saying, is one objective that we are going to have as customer focus has enhanced, and it is important. If you are able to retain your customers, that means there's a good chance that you are going to maintain or increase your market share. If the same customers are going to come to you, then the chances are that you will maintain your market share. You might even increase your market share. So customer focus, customer objectives, retention is going to be one objective, measured in terms of average duration of customer relationship. So whether a customer has been retained or not, how will you measure? And of course, these are all estimates, and some kind of estimation is required, but it is always useful to have that estimate and to have that information. And one way, we said, of measuring retention of customers is to see the length of time and duration of a customer relationship. So you can, therefore, you need information of who your customers are and whether they are coming to you again and again, and if they are your customers, and for how long are they your customers. So you estimate the length of time that you have a customer relationship, and that is an indication of whether you are retaining your customer or not. So customer retention, one way of measuring. Again, I say measuring means we are estimating. These are estimates. And the length of time over which you have a customer relationship, this reflects whether you are retaining your customer or not. Surveying defecting customers and their reasons can provide valuable feedback. If the customers are being retained, they are with you. But if they are not, then they have gone to use other products or other brands and other makes. So those are what are referred to as defecting customers. They have defected, they have gone to use some other products. Very often, market information provides a basis of a lot of management strategy. So a lot of attention and focus is given to market surveys, and organizations try to survey in the market and question and try to obtain information from those customers who have stopped using your product and they have started using some other product. So they are defecting customers. What complaints did they have? What problems did they have? Or what are the improvements in the new product? So you take their view in surveys, and that provides you the information which can form the basis of your strategy. What you should do. If the customers are regarding your product as inferior to other products or less satisfactory, and they have a preference for other products, you would like to know what are the reasons, and therefore you can formulate some strategy and some kind of other initiatives to try to overcome the issues and to win back or improve your customer relationship. Customer loyalty can be measured by number of new customers referred by existing customers. So continuing with the customer perspective, we are saying that customer loyalty can be measured by the number of new customers that are referred by the existing customers. This means that the existing customers, they are consuming your product and coming to you, but then they are also recommending and suggesting others to use the same product. So this is a referral. And so if you have information that can track this kind of an event where a new customer has been referred by the old customers. Again, this is coming and as a result of many surveys that organizations do, that when new customers join, they ask them to indicate where they heard the name or how they were introduced to this new product. So when you find that your customers are referring others to you, this means that there is a measure of customer loyalty, and you can then regard that customer retention and customer loyalty, all these efforts are producing a good result. So these are the measures for customer retention. As I say, these are all estimates, these are all survey results, and these are all therefore indicators and not very precise, accurate, exact results. Customer acquisition satisfaction. Look at customer acquisition first, measured by either number of new customers or total sales to new customers in the desired segment. Customer acquisition, this means you have acquired new customer. So this is showing you how important the customer focus is becoming for businesses, that they need to be aware and they need to have the information that whether the customer that comes to them is a new customer or an old customer. And whether if it's an old customer, then that's a customer retention. If there's a new customer, then that is where they are acquiring and adding customers. And the way in which they can estimate this is to have information of sales. They need to have information of their customers, which they will, and then they can identify that these are new customers, and therefore they can estimate the total number of sales that are made to new customers. That will give an indication. The sales invoice which they produce normally has the name of customer on it. So by looking at the record of your sales invoices, you can estimate and you can from that quite accurately estimate what are the sales to new customers and what are the sales to existing or old customers. So the customer acquisition, one measure of that is the sales, total sales to new customers. Other measures include the number of new customers expressed as a percentage of prospective inquiries, or the ratio of new customers per sales call. So we are now again looking at measures for new customers. How do you estimate and how do you measure new customers? And in this method, in this last measure, we are referring to the percentage of inquiries that result in actual sales. So you can call that conversion of inquiries into sales. And if you have, you can even make an estimate that in one day or in 1 week or whatever period, a reasonable period, suitable period, in that period, what are the number of inquiries of your product, and then what are the number of actual new sales. So that will represent as a percentage, what is the percentage of converting the inquiries into sales. So a measure of the new customers are based on the proportion of inquiries that convert into sales. And the other measure we said is the ratio of the new customers per sales call. Very often companies, in order to make their sales, especially where the products are larger products and more valuable, higher value products, such as washing machines and things like that, there the sales calls are made on a, you can call that door-to-door basis, where the salesman will go and introduce their products to the various customers or potential customers and consumers, and try to of course point out the advantages and try to make the sale. So from there you can see the number of sales calls made and the number of actual sales made, and that will give you an indication of whether you are acquiring new customers. So that is a measure. We said there are two measures. One is as a proportion of prospective inquiries, and the other is the percentage of sales called that convert into actual sales. Customer satisfaction involves use of questionnaire surveys and customer response cards, also measured by letters of complaint and other means of feedback. Now we are talking about the measuring of customer satisfaction. Again, this is based on questionnaires and surveys. Customer satisfaction, usually organizations make out a questionnaire, a list of questions, simple and easy to answer, so that all the customers can within very quickly provide you with the answers, give you the information of whether they are satisfied with your product or not. Questionnaires and surveys are providing valuable market information. So for organizations to be aware of where they are in terms of customer satisfaction, how their product is rated by the customer, then these kind of surveys should be a regular thing, and market information should be regularly obtained. And things such as surveys and response cards. What is a response card? Wherever you use a service, and this happens very often in restaurants where you go and eat, and then you will have a card that you can fill in and say whether you were satisfied or not satisfied with the various things, the food, the environment, the ambience. So this is a response card which will give an indication. Very often on the airlines, in the flight, you will find PIO says that you can give your responses on a card, and we will value that kind of response. So that is a response card that you can provide your information, your feedback, and your response of the quality of the service to the providers of the service. So response cards and surveys, these are two methods of measuring customer satisfaction. We mentioned while talking about customer satisfaction the aspect of customer dissatisfaction. That's an important thing also to know. And there are various ways of knowing about customer dissatisfaction. The information that you get from customers regarding defaults, faulty goods, complaints, letters of complaints, and your own returns of goods which are faulty. These are all indications, and you can be quite sure that where a customer is complaining, he's not satisfied, where is returning a good, he's not satisfied. So customer satisfaction can be measured by the defects in your products, and the defects and the number of defects and the frequency. Hence, customer satisfaction is measured by surveys, and dissatisfaction is measured by defects and complaints. Both these aspects give indication of where the customer position is, and that helps to evolve and formulate strategy with regard to your products. Customer profitability. Profitability should be analyzed by different customer segments. What is the segment of a customer? If you take the example of any product and you find that that product is being used A, in houses, B, it is used in offices, C, it is used by the markets, the shops, the stores. So these are different examples of different segments of your customers. The housewives, the offices, the corporate sector, and the market and the stores and those. So you can look at customer profitability. This is one example. There can be many other examples of segments of customers where your products are used at different levels by different type of people. So customer profitability is important, and you need to know whether within that segment those customers are profitable. And I mentioned to you that you might find that the customers where you find there are large buyers in large quantities, in actual fact, if you are having to offer too many services and too many special type of treatments and special orders and different requirements that have to be met, you might end up spending more, and the cost might increase to the extent that those customers do not remain profitable. Unprofitable segments identified. Newly acquired customers may initially be unprofitable. Life cycle profitability analysis should be used. So one thing is to identify the unprofitable customers. When you identify the unprofitable customers, then you can take some corrective action. You might find that customers are unprofitable because of their detailed requirements and alterations and different types of adjustments that they need to the products, and therefore you end up spending a lot of cost to satisfy the customer. So if you identify such customers, then you can take some corrective actions, which include maybe cutting down the discount or might even involve increasing the prices sometime to match with the additional requirements. So that's one thing, which is identifying the unprofitable customers and therefore finding a solution and solving that issue. When you sometimes acquire new customers, then initially they can be unprofitable, but if they are customers on an ongoing basis, then in the long run they can become profitable. So profitability can also be viewed from a life cycle perspective. And we talked about this before. Life cycle perspective means when you start, a customer starts and he starts to be your customer, and then he continues and buys until he no longer is your customer. So that's the life cycle of a customer. So you might find that initially when you get a customer, you might have to help him in understanding your product and make alterations to satisfy him, but ultimately he's going to have repeat purchases which are going to be profitable. So you can look at the customer profitability from a life cycle perspective. Actions to make customers profitable may include altering their buying behavior so they consume less resources or prices increase. Where you have then identified the customers who are unprofitable, then you might need to take actions to cover the cost, and you might need to correct either by adjusting the discounts or sometimes adjusting their prices. This will ensure profitability of the customers. That's all for this session. Thank you for listening.